Hey everyone, so Tung, who's the admin from the Savvy Investor Facebook group, and if you're part of that group, you know there's some phenomenal stuff shared in there. And we've been doing a few videos together lately, and how we've been doing it is we'll record it and then we'll put say part one on his YouTube channel, part two on my YouTube channel. So just so you're aware, make sure you're subscribing to his YouTube channel as well, because if you want to see the video prior to this one on energy, part one is on his YouTube channel. Link will be in the description. And then this is part two now. So if you're kind of wondering how we've kind of picked off halfway through, that's why, because he's got part one on his and this is part two. So if you're interested to see how, you can combine macro with TA, that's kind of what we're doing. Tung hasn't used TA once in his life. And he's made some great gains on the market by using his macro analysis. I, as you know, combine TA with macro, but I don't have that depth of knowledge that even Tung has. So that's why I love talking to him, just diving deep into his brain around that. And then I'm teaching him ways that you can actually what you're talking about there, I can show you that on this chart and how you can actually time it better as well. So I did a post about this the other day. Macro analysis is never wrong. It just takes time to play out. Because people think when, something is showing this, that it's going to happen within a day, a week, or even a month, or even the year. Sometimes it takes, years to play out. And that's where TA can come in to help you time it better. All right. So, and that's what Tonga often says. He's often very early because he sees it playing on the macro analysis. But then what happens is big money then distributes. Because you got to remember, big money takes time to exit their positions. And unless you've ever been big money and understand the process of it, you can't sell your positions in one hit. So often what they have to do is they have to mask it and they have to take their time getting out of their positions. And then they do the same down the bottom as well. These are called accumulation and distribution ranges. Okay. And that is why things take time to play out. But anyway, I won't go into that. Let's get going on the video. Make sure you go and watch part one on him first and then come over and watch this one. All right. Hope you enjoy the video.
Slides. Okay, so one of the things, or one of my favorite quotes from Mark Twain is history doesn't repeat itself, but it certainly rhymes. And the last time we had a bit of an energy crisis was during the 1970s. There was the Iran-Iraq war. And now we're in the middle of the Ukraine-Russian war. And last week, have you been following what's been happening with Israel and Palestine?
Yeah,
Messy.
very sad. Yeah.
Very messy. Now, Israel and Palestine aren't oil-producing nations, but they're surrounded by oil-producing nations. And my concern is there's going to be supply chain impacts of
100%.
trucks, of goods, of components that are required for equipment manufacturing. There might be, no conflict zones. My wife and I were planning a trip to go to Egypt, and we looked at the map, and there are certain red zones where you can't go through, amber zones where it's risky, and green zones where you can. And so when you start seeing those patterns emerge across the Middle East in an oil-rich country, it makes the supply of oil, the free flow of oil, so much harder. Yeah, so already, even before the recent conflict, we're seeing Russia cut its output, we're seeing OPEC cut its output, and we're seeing clear examples of sabotage of the Nord Stream pipeline in Europe. History doesn't repeat itself, but it certainly rhymes.
100%. That's why that's one of my favorite quotes. I always say, often the answers you seek in the future can be found in the past.
Oh, I love that.
I love it.
Where did you hear that from?
I just made it up, but I'm sure there's something very similar out there. Who knows? I probably read it somewhere and, you store it and don't realize, but yeah, it's just so true.
I agree. The last time I heard it was from Dalio. And like you mentioned the past, I love looking at the past. So I pulled up some photos of the 1970s. On the right-hand side, you can see traffic lines of people trying to get to petrol stations and getting fuel, and they've run out of gas. But we're not the only ones who kind of figured out there's a correlation between now and the 1970s. There was analysis that was done by the US Energy Commission that kind of likened this period to the 1970s as well.
Well, even look at the yield curve, same as the 1970s as well.
Scary, huh? And inflation. just
Yep.
like the 1970s. There's a
Yep.
lot of similarities between now and the 1970s.
The only thing
Um,
that's different, that's even scarier, is that the one thing we didn't have in the 1970s was
yep.
actually expensive equities. So
We didn't
equities
have
weren't
it.
actually, no, so they were okay. Like I
Ooh,
think the Schiller period was around 25 or 24. So it was above the average, but it
yeah,
wasn't extremities like it is now. Yeah, so that's the thing. We haven't had extreme valuations at this same level as well. And
yeah.
that's the thing. That's a little, and we also haven't had extreme real estate prices or extreme and bonds as well. So that's why a lot of people call it like the super bubble. It's the first
The
time we've
everything
actually,
bubble.
yeah, and
That's kind of
they're,
scary.
yeah, they're right. And people have knows, and like I've been talking about with the macro, like they're right. All these people are saying it's super bubble, it's right, but when does it pop is the question. Yeah, and that's the tricky thing.
Yeah. There are a few ultra wealthy people that I know that have liquidated their commercial property, they've liquidated their shares. They're basically just sitting in cash and they're
Mm,
just waiting. Um,
mm,
they can afford to wait.
yeah.
Um, there's
Well,
an
yeah.
opportunity cost associated with it, but they're just waiting for the moment to pounce back in.
That's the thing I always tell about people. I'm like, you got to remember the people that move the market, they're not trying to get rich. They're already rich. Their whole thing is about wealth preservation, not about,
Preservation,
yeah, not about getting more richer. They're
different
already,
game.
yeah, it's a different game. And
It's a
that's what people
different
don't
game.
understand. Most people
Yeah,
have that mindset of how do I get rich? They're already rich. They've got everything they've ever
yeah,
dreamed of. It's all about keeping it. And
yeah.
they don't understand that. So that's why they start to play defense. I always say it's like in a basketball game. If you're up by 50 points, you don't have to go out there start shoot
Yep.
every hoop again. You're like,
Play
okay, it's
safe.
now time to play defense. Play it safe.
Play safe.
Yeah, we've got the lead. It's all about keeping the lead.
Yeah, yeah. That's a good point. So coming out of the 70s, after we had all of these oil shortages and we had like long lines at petrol stations, one of the things the US started to do was start to build up a strategic petroleum reserve. So,
Mm-hmm.
in the event when the shit hits the fan, they've got petrol for things like, tanks and airfares and aircraft and helicopters. And so they started to steadily build up their petrol reserves from
Mm-hmm.
1977, and it got to about was it 700,000 million barrels. It's an awful lot.
Mm-hmm.
But the one thing that you notice is after around about 2020, it just dropped off a cliff,
Oh
and
yeah.
so it's nearly not quite half what it was at the peak. But if you go across the line, we're back to like 1985-ish levels of
Mm-hmm.
strategic petroleum reserves.
Yeah. And I thought it was lower than that. Is that the most current one?
Probably not. No,
Yeah,
no.
I think it's
It's
actually even lower. I think it's back to like pretty much where they
like the
started now.
1970s.
Yeah. Yeah, I think it's real. Yeah, it's shocking. Man, yeah, same thing. This is almost like you've got your car full of petrol, you've run low. And
Yeah,
then, so, okay, well, let's carry out the petrol station. We keep getting it. But the problem is now the petrol station is running out of petrol.
yeah.
What do we do? And that's the thing. They've been going into these reserves, but what happens when the petrol station runs out of fuel as well? Yeah, so that's the thing. Biden's been keeping the price down probably for
Yes.
for re-election, so it doesn't look too bad. And then
Yes.
once he's re-elected, who cares? I got 4 years up my sleeve.
It'll be interesting how low they let this go before they
Mm.
go, you know what, we're going to have to let the price free float because we can't control it anymore.
Well, it makes sense. Like if you think about COVID, no, like I don't know if petrol was back to 70 cents or something. It was the lowest I'd seen it since
Mm,
probably the 90s. And then a lot of those miners shut down because they couldn't make money. Like,
yep. Couldn't
they were
work.
unprofitable. There's no point mining it if they're selling it for 70 cents.
Yep.
Um, so yeah, so then when we started to do it all again, and then they all started to come back online, some of those smaller ones never came back, and
Yeah.
then they couldn't then compete with what they actually needed. So now that's why we just didn't have enough of it.
Yeah. There's less supply.
Yeah, yeah, it's all just supply and demand.
Okay. So how's the energy sector performing at the moment? Actually, I might get your thoughts on this. That divergence on the right-hand side
Hmm.
is fascinating.
Yeah, so what's that one? You got energy against the SP5. Yeah. So yeah. All right, cool. Yeah. I'll pull that up now. So let me pull back. here. All right. So, so the thing with the energy sector is, and again, you got to remember markets move in three phases. So you have uptrend, sideways, downtrend, or uptrend. Like that, they only move three ways. And what you've got to remember is since here, oh wait, top of the GFC, energy has been
It's
terrible,
flat. Yeah.
gone sideways. The thing is, if you look at last time down at the tech bubble, what did it do? It went ballistic.
Mm-hmm.
So after every ballistic run, you get it needs to cool off, it needs to chill. Everything goes in cycles. Okay, so if this has been going sideways while Nasdaq and all that things have been going ballistic, it would make sense that things go in cycles. That if Nasdaq stops going ballistic, that then maybe this thing starts to then trend again. All right, so what you're looking for is it to break out of these levels here. All right, so if we ever break out of there, what you're then breaking out of is you're breaking out of a 15-year base, which is huge. I always say the old saying, bigger the base, bigger the explosion. That means it's been chilling for 15 years doing nothing. It's dormant. It's like a dormant volcano. Boom, then it erupts. All right. Whereas if you look at and I always think about Microsoft, that was the number one stock in the world before.
I love that story.
Like, look at this thing here. It went absolutely ballistic.
And then nowhere for like 16 years.
Exactly. 14, 15 years. It then chilled and went sideways.
Yeah.
Then it's gone ballistic again.
Yep.
Okay. So it would make sense that now it's going to, whatever it's going to do, it's either going to correct or it's going to chill sideways for like it's
a long time.
You know what I mean? It's had its move, chill. Had its move, chill, or whatever. So, you know what I mean? So that's technology. So knowing that kind of thing is where you've got to then go, okay, well, let's look at the next thing. And looking at our Australian energy sector, it really paints the picture for you. So you can see here again, it was look at this. Since the tech bubble 03 here, it outperformed massively. It ran, see the parabolic run? Nothing moves that fast without a correction or a pullback.
What kind of multiple is that from base to top?
Oh, good question. Price range. It has gone. Yeah, nearly 500%. That's on an index. So you can imagine what some of the individual stocks would have done there. At least 10, some 20, some higher. Yeah. And that's why ExxonMobil was the number one stock in the world then.
Yeah.
In 2000, the number one stock was Microsoft. In 2010, at the end of the decade, it was an oil company, ExxonMobil. So, and then now what have we got at end of 2020? Apple, another technology stock. So what do you think might be the number one stock at the end of 2030? Possibly back to energy or commodity or something, it just flips and flips. But as you can see here, lower, 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 lower. And then now we're at this level. And this is the level that I'm watching right here.
Yeah.
Right there. Because you can see buyers, 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 buyers became sellers, 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 sellers. So if those sellers are exhausted and then become buyers, we've got to change a character. We've got to flip. We then go boom. We then go, that means uptrend, correction, next move up. So that's how it works. And that's what I was talking about. If you look, technology has been going ballistic for the last 10, 15 years. Energy has been a terrible investment. It's been going nothing but down. But that, doesn't mean that it's going to always keep going down. So yeah, that's what I'm saying there.
So there's almost two parallel narratives that are happening. One is you've got rotation money. People have invested significantly into the Nasdaq and tech, and they're cycling out. They're taking their money and like moving it somewhere else because they need to put it somewhere. And energy looks cheap. So that's one narrative. The other narrative is the demand narrative, which is we're using so much more of it. And there's a war going on that's putting constraints on supply, and prices are going to have to go up whether we like it or not.
Yeah.
And both are bullish for energy at the moment.
100%.
All right. So if I go back to the slides, what I love about this one is what the chart shows is how much money is actually getting invested into the energy sector. And what I kind of noticed is the green line's renewables and the black line is traditional oil and gas money. So you can see how much money was pumped into investment. And there was an awful lot around about 2012. It peaked and then it's been slowly in decline when they realized that they couldn't get an ROI. But if you look at oil and gas, investment in oil and gas has also been trending down, despite the fact that consumption has been steadily increasing. So what that means is, if you invest in energy, it's going to take 5-10 years before you actually get a return on the supply. You don't get the oil coming out of the ground straight away because we've underinvested for the last decade. We're supply constrained for the next decade. So when I combine this chart with the demand chart that we saw back here, there's a price explosion coming because all of macro for me comes back to supply and demand. And what this tells me is demand is really, really hot and supply is going to be screwed because we've underinvested.
Beautiful chart.
I love how, like, when you string a bunch of charts together, it tells an amazing story.
Oh, yeah. Story of my life. I'm always saying that. The market tells a story. It's so obvious if you know where to look. It literally just paints a picture and you can see it. And you can even show people so obviously and they still deny it. You're like, I just don't get it.
Yeah, I think people just get wedded to a narrative and they stick to it. Anything more you want to talk about on this slide?
No, that's fine.
Right. So uranium. So this is the price chart of uranium over time. There are very few commodities that I can think of that are cheaper today. It's like $30 per pound of uranium. There are very few assets I can think of that are cheaper today than they were back in 2007. Admittedly, that was a very peaky peak in 2007. The only thing that I can think of that reminds me of this chart is probably silver.
Yep. But it's still got another peak up, didn't it?
Yeah. So after, I think it was like the 1980s, it got another peak up in 2011. But right now, the price of silver, like the price of uranium, is still below its all-time peak like decades ago.
We should do another whole video on that one. I'd love to unpack gold and then silver as well.
Oh, silver. Yeah, I love silver. I actually like silver more than I like gold.
Me too.
Yeah.
But gold, yeah, it's like it's kind of like the crypto market, like Bitcoin. Bitcoin will run first.
Yes.
Then once it kind of like sets the pace, then the altcoins catch up. It's the same thing. Gold will run first, and then so that's why I'm more positioned in gold first, and then once it's kind of moved, then because you got to remember silver's tied to the industrials as well, so it doesn't always perform straight up the bat.
Yep.
Especially if we have that kind of fear and drop in the stock market, and that it'll be gold will be your pure play straight off the bat. Then 100%, I'll be then starting to convert some of my gold plays into my silver as well, because it will 100% outperform.
Yeah, we should totally do another video on gold and silver. Okay, so that's the price of uranium. So I'm really bullish because it is ridiculously cheap in terms of historical price points. And the thing that most people don't know is nuclear energy is actually quite green. Like when you think of the amount of CO2 emissions that comes out of nuclear, it's like 3 versus wind and solar and hydro. And the reason why that's the case is you just get so much energy from all your effort.
Yeah. But it's like people that don't understand that, like if you just ask the common person on the street, they'll think nuclear is the worst just because they've heard of a news story about nuclear meltdown. Fukushima. Yeah, exactly.
Awesome. So that's all the slides that I prepared. Is there anything else you wanted to cover, mate?
Yeah, just pretty much just always talking about the fact that, the market is forward looking and that people are always chasing yesterday's gains.
Yep.
And one of my famous quotes I always talk about is Wayne Gretzky, go skate to where the puck is going.
Okay, Wayne Gretzky.
Yeah. So best ice hockey player of all time. And, one of the things
Yeah.
that he said was, how are you so good? It's like, well, I don't wait. I don't go where the puck's go. I go to where I think it's going to be going. So he's always 2 steps ahead of the game. And that's what you've got to be in the market as well. You've always got to be 2 steps ahead of the game. You've got to think about, okay, well, what's about to happen, knowing, and again, always going back to history to find your answers for the future. That's the only way to make money in the market, is to skate to where the puck is going. So look to the future, not to yesterday. And unfortunately, people are conditioned to the NAG's has gone up 15-20% every year for the last 10 years. That's
That must be it.
Yeah, but it doesn't always go that way. Everything runs in cycles, just like the planet runs in cycles. Just when you're in the peak of summer and you kind of can't remember what it's like to be cold, that's probably when you're actually at the top of summer, and then it starts to cool down and get better. There you go. Oh, did you already have that prepared?
No, I found it.
Oh. Yeah.
The way you are with charts, I am with images.
Yeah, exactly right. So, again, that comes back to Dow theory. The market discounts everything. So you have to be a forward looker. You have to be knowing what's going to happen, not what has already happened.
So to make the best out of this market, are you looking at are you looking at an index play, or are you looking at specific energy producers?
I always, because I have different accounts. I have long-term accounts, which is where I only look at those positions 4 times a year. I have medium swing accounts, which is where I look at them kind of on a weekly, monthly basis. So I'm looking to hold those positions for weeks to several months. Sometimes they even turn into years as well. And then I have a short-term trading account, which is where, sometimes I might hold it for a few days or a couple of weeks, that kind of thing.
Okay.
So
what are you trading in the short-term ones?
So I was massively in uranium, and I took profit on that last week and put it into gold. And now I'm sitting on the gold miners until they kind of give me a signal. But I'm still holding 100% of all of my uranium in my swing and my long term.
Okay.
Which is, and that's just, you can't get every decision right. And what it does is it puts money in your bank account, but it also keeps a horse in the race, so that if it keeps going, you don't get FOMO and, when you've taken profit too early or something like that as well.
Yeah.
Because like I said, the market doesn't move up in a straight line. You have ups and downs.
Yep.
So you just have to adjust the time frame to suit your kind of investing style. But, even if you look at, some of our, like Woodside's our biggest one on the Australian market. And again, like, it was an absolutely beautiful chart in the night. Like, picture if you only had that. Like, look at it. It's beautiful.
Could you share the screen?
Oh, yes, I can. All right. Look at that. Best chart in the world, isn't it?
That's good.
It'd be like Woodside. And if you were to ask your parents what they're invested in the 80s, they would have loved oil. They would have loved, to be honest, knowing what's probably going to perform for the next decade. Ask your parents what they were invested in the 80s, because that would have been the peak of what had just performed throughout the 70s. You know what I mean? Because think about it, retailers are always bullish on whatever, they're bullish kind of towards the top of what was performed for the last decade.
And then it did nothing for 20 years.
Exactly.
Did nothing.
Yeah. So, that's what Woodside was, and how many charts look like that. And these are the 3 phases I always talk about. So this is your first phase, where people aren't aware of it. It's not over the news. People aren't bullish on it. This is your public participation phase, where, it starts to get a bit of traction. Then this is your excess phase, where everyone's bullish. This is where the dumb money starts to buy in, and this is where the smart money starts to exit.
Yep.
All right. And then, as you can see, what happens after that is that we then, what did we do? We've corrected ever since.
Yep.
That's mean for every move like that, you get corrections. But I guarantee, if I was on the markets then in 2008 saying we're going to correct, I would have probably got the same response I got when I talked about lithium last year as well.
Yeah.
Oh, you're an idiot. Have you seen the chart? But Everything moves in phases. But what have we done? Lower low, lower high, lower low, lower high. We're trending down. If we get above here, that is a major, major point, just like the energy sector I showed you as well. So if we break above that level there, you can see sellers, sellers, sellers. If this was to come up, it means these sellers have been exhausted. There's no more sellers left. Then what I always look for is those sellers to become buyers. And that's the ultimate flip. Because not only have your sellers been exhausted, but then your buyers are stepping in at that point. And that's when things start to change.
In terms of exposure, you're looking at overseas stuff as well, or mainly Australian stocks for uranium?
For uranium, no. I always go in a few of the big boys, and I always Paladin's producer. So, I talked about the phases. Again, first move, correction. We should be moving into the public participation phase now. So we've only had the first wave. The biggest waves are still yet to come, which is your wave 3 and your wave 5. So we're only at the very, very beginning, where people still are, they're still doubting it. They're still not sure. But if we start to break out above here, then we're moving into that period. So PDN, DYL is another one that I really like. Same thing. It had been a terrible, look at this. It had been a terrible investment. But see how then it forms a bait, like sideways, and then it's starting to break up out of here as well. So then we're starting to move into an uptrend again. So so that things like that. And then what I do is I'll play the ETF in the long term, because remember, the long term is like, I don't want to have to think about it or worry about an announcement coming out that something happens and the thing drops 30% that day. That's like I know the sector's strong. I can just set and forget, let it do its magic and hold it for years. In my swing account, what I normally do is I play the big boys. Like I play the kind of the bigger ones within the sector. And then in my kind of short term as well, what I'll start to look at is I'll start to look at some of the penny ones as well. And I like to pick a couple from the very top, a couple from the middle, and a couple from the bottom.
Interesting.
Yeah. And that's when I start to do the deep dive. I look into the TA, and then
interesting.